They told you it couldn't happen here. They told you Canada was exceptional. They told you that while the American housing market collapsed in 2008, built on a foundation of greed, stupidity, and criminal negligence, Canada stood firm. We were the world's soundest banking system. We were prudent. We were regulated. We were safe. This is the foundational myth of the Canadian economy. It is a story we tell ourselves to justify paying $2 million for a bungalow in a frozen suburb. It is a story repeated by politicians, by bank CEOs, and by real estate agents. But I am here to tell you that it is a lie. Canada did not avoid the 2008 financial crisis because we were smarter. We avoided it because we cheated. We delayed it. We took the toxic debt that destroyed the American economy, renamed it, repackaged it, and allowed it to fester in the shadows for 18 years. What I'm about to show you is not a conspiracy theory. It is a forensic accounting of a disaster that has already happened but hasn't yet hit the books. The subprime crisis is not a history lesson from America. It is the mathematical reality facing Canada in 2026. You are watching the Northern Ledger. Welcome to the end of the illusion. To understand the catastrophe that is forming right now in the suburbs of Toronto and Vancouver, we have to go back in time. We have to understand the specific mechanism that created the monster. In 2008, the United States suffered a subprime mortgage crisis. Banks had lent money to people who could not pay it back. The infamous ninja loans. No income, no job, assets. When those borrowers defaulted, the banks collapsed and the global economy melted down. In Canada, we looked south and laughed. We patted ourselves on the back. We said, "Our banks are conservative. We don't do subprime lending." But that wasn't entirely true. Behind closed doors, the Canadian government orchestrated a massive liquidity swap to save our banks, buying billions of dollars of insured mortgages to keep the ledger balanced. We didn't let the market correct. We didn't let prices fall. Instead, we doubled down on real estate. We decided that housing would not just be shelter, it would be our primary GDP generator. For the next decade, interest rates were pinned to the floor. Free money flooded the system. Prices doubled. Then they tripled. A generation of Canadians learned a dangerous lesson. Real estate only goes up. You cannot lose. Leverage is your friend. But by 2017, the cracks were starting to show. The debt levels of Canadian households had become terrifying. According to OECD data, we were the most indebted people in the G7. The government and the regulators knew they had to slow it down before it exploded. So, on January 1st, 2018, they introduced Guideline B20. You know it as the stress test. The intention was noble. The idea was to force borrowers to prove they could afford their mortgage not just at the current low interest rate, but at a hypothetical higher rate, usually 2% higher. It was designed to create a safety buffer. It was designed to stop people from taking on too much debt. But in economics, there is a law called the law of unintended consequences. When you build a dam to stop a river, the water doesn't disappear. It just finds another path. It flows around the wall. The stress test instantly disqualified roughly 20% of potential homebuyers from the traditional banking system. Suddenly, hundreds of thousands of Canadians, immigrants, self-employed contractors, gig workers, small business owners, were locked out. These were people with money, people with jobs, but people who didn't fit the strict new boxes of the Big Five banks. But these people didn't stop wanting homes. The Canadian dream didn't die just because a bureaucrat in Ottawa signed a piece of paper. The demand was still there. Desperate, foaming at the mouth demand. And where there is desperate demand, a supplier will always emerge from the darkness. This is the birth of the modern Canadian shadow banking system. Technically, we use polite terms. We call them alternative lenders. We call them B lenders. We call them private lenders. It sounds professional. It sounds like a legitimate part of a healthy financial ecosystem. But let's call them what they actually are. This is the subprime market. To understand how dangerous this is, you need to understand the hierarchy of Canadian lending. At the top, you have the A lenders. These are the big five banks: RBC, TD, Scotiabank, BMO, CIBC. They are regulated. They are federally insured. They are safe. They lend at the lowest rates, but they have the strictest rules. Below them, you have the B lenders. These are credit unions and trust companies. They are slightly looser, slightly more expensive, but still regulated. But at the bottom, in the murky waters underneath the economy, lies the private lending space. These are not banks. They do not take deposits from grandmothers. They are not regulated by OSFI. They are mortgage investment corporations, or MICs. They are private equity funds. And increasingly, they are just wealthy individuals, doctors, lawyers, dentists, pooling their money to lend it out. When the big banks said no to the Uber driver, the private lender said yes. When the big banks said no to the real estate speculator who already owned 5 condos, the private lender said yes. When the big banks said no to the new immigrant with no credit history, the private lender said yes. But their yes came with a price tag that would make a loan shark blush. While a bank mortgage might cost 4%, a private mortgage costs 8, 10, or 12%. Plus fees, lender fees, broker fees, setup fees. In a sane world, nobody would take these loans. Why would you borrow money at 12% interest to buy a house that yields a 3% rental return? The math is negative. It is financial suicide. But in the Canadian housing bubble, math didn't matter. Only the asset mattered. Borrowers told themselves, "I just need this loan for 1 year. Just 1 year. My house will go up in value by 20%. I will build equity. Then I will refinance with a real bank." This was the trap. The private lending industry is not designed for long-term homeownership. It is designed for short-term speculation. Unlike a traditional bank mortgage, which is amortized over 25 or 30 years, most private mortgages are interest-only terms for 1 year. Let me repeat that. 1 year. The borrower is not paying down any principal. They are just renting the money. They are treading water, hoping that in 12 months the tide will raise them up. For a few years, it worked. Prices kept rising. The shadow banking sector exploded in size. In some suburbs of the Greater Toronto Area, like Brampton and Mississauga, it is estimated that private lenders now account for 20 to 30% of the market. That is billions upon billions of dollars of unregulated, high-risk debt sitting on the books of entities that have no government backstop. But what happens when the tide goes out? What happens when the borrower comes back after 1 year to refinance, but the house hasn't gone up in value? What happens when interest rates haven't stayed low, but have tripled? We don't have to guess. We are seeing it happen right now. But before we look at the collapse, we have to look at the fraud. Because you cannot have a subprime crisis without rampant systemic fraud. In 2008, America, they had ninja loans. In 2025 Canada, we have the Brampton loan. Reports from investigative journalists suggest this is an open secret in the mortgage industry. The Brampton loan is a colloquial term for a mortgage obtained through allegedly fabricated income documents. Imagine you are a gig worker earning $40,000 a year. You want to buy a $1 million townhouse. The math says impossible. The stress test says impossible. But for a fee, usually 1% of the mortgage amount, paid in cash under the table, a shadowy network of mortgage brokers will fix reality for you. They will create a fake job letter from a numbered company. They will create fake T4 slips. They will create fake pay stubs that show regular deposits. Suddenly, on paper, you aren't an Uber driver earning $40,000. You are a senior logistics manager earning $150,000 a year. You take these papers to a lender. Sometimes, even the big banks are fooled, but more often you take them to the shadow lenders. And here's the terrifying secret of the shadow banking world. The lenders often know the documents are fake, and they don't care. Why? Because of asset-based lending. The shadow lender isn't betting on your income. They know you can't afford the monthly payments. They are betting on the house. As long as they have 20% equity in the property, they feel safe. If you default, they think they can just take the house and sell it. It is a cynical, predatory model that relies on the greater fool theory. It relies on the belief that there will always be someone else willing to pay more for that house tomorrow than you paid today. But this system has a fatal flaw. It assumes liquidity. It assumes that houses can always be sold instantly. It assumes that prices never fall. This ecosystem of fraud, greed, and desperation grew unchecked for 5 years. It pumped billions of dollars of phantom demand into the market, driving prices up for everyone else. It forced honest families to compete against fraudsters armed with fake money. It turned the Canadian housing market into a Ponzi scheme wrapped in a maple leaf. And like all Ponzi schemes, it requires a constant inflow of new money to stay alive. If the borrowers are the fuel for this fire, then the investors are the oxygen. To understand why this system hasn't collapsed yet, we have to ask a simple question. Where is all this money coming from? Who is lending billions of dollars to Uber drivers with fake documents? Let me introduce you to the yield chasers. For 10 years, from 2010 to 2020, interest rates in Canada were effectively zero. If you were a prudent saver, a retiree, a pension fund, a careful investor, you were punished. You put your money in a savings account and it earned nothing. You bought government bonds and they paid nothing. Money hates to sit still. Money needs to grow. So, billions of dollars of Canadian savings began to look for a new home. They looked for yield. And the shadow banking industry was waiting with open arms. They marketed themselves as mortgage investment corporations, or MICs. They ran glossy ads promising returns of 8, 9, or even 12%. And the magic words were always the same: secured by Canadian real estate. It was the perfect sales pitch. Canadians have a religious belief that real estate never goes down. So, when a dentist in Ottawa or a retired teacher in Calgary saw an offer to earn 10% interest secured by a house in Toronto, they didn't see risk. They saw a guaranteed win. They poured their life savings into these funds. They thought they were being smart. They thought they were becoming the bank. But they forgot the most important rule of banking. You are not a bank unless you have a central bank behind you. A real bank, like TD or Royal Bank, has billions of dollars in loss provisions. If 1,000 homeowners stop paying their mortgages tomorrow, the bank will bleed, but it won't die. It has vast reserves. It has insurance. And in a worst-case scenario, the Bank of Canada will print money to save it. A private lender has none of these things. A mortgage investment corporation is just a flow-through entity. Money comes in from investors, goes out to borrowers, and the interest payments flow back to investors as dividends. It works beautifully as long as the music is playing. But what happens when the borrower stops paying? The flow of cash stops instantly. The dividend checks stop arriving. And here's the nightmare scenario for the yield chaser. When they realize something is wrong, their first instinct is to pull their money out. They call the fund manager and say, "I want to redeem my shares." But the fund manager says, "I can't pay you." Why? Because your money isn't in a vault. It is inside a house in Brampton. And the owner of that house hasn't paid us in 3 months. And we can't sell the house because the market is frozen. This is called a liquidity trap. We saw the first tremors of this in late 2023 and 2024. Several prominent private lenders in Ontario froze redemptions. They sent letters to their investors saying, "Sorry, we are halting withdrawals to protect the integrity of the fund." That is corporate speak for, "We ran out of cash." Currently, there are billions of dollars of investor capital trapped in these zombie funds. The investors are looking at their monthly statements, seeing a balance of $100,000 and thinking they are rich. But that money is a mirage. It is tied to an asset that is rapidly losing value. When they finally get access to it, it might be $50,000 or zero. So we have a shadow banking system filled with fraudulent loans. We have investors who are oblivious to the risk. We have a market that is fundamentally disconnected from local incomes. But a pile of dynamite is not dangerous until someone lights the fuse. That fuse is the year 2026. Why 2026? Why is this specific year the point of no return? It comes down to simple, brutal arithmetic. During the COVID-19 pandemic in 2020 and 2021, the Bank of Canada lowered interest rates to emergency levels. Mortgage rates hit historic lows of 1.5%. Canadians went into a frenzy. We bought more houses, took on more debt, and leveraged ourselves higher than ever before. Most of these mortgages were 5-year fixed terms. Now, do the math. 2021 plus 5 equals 2026. In the year 2026, a tsunami of renewals is going to hit the Canadian shoreline. The Canada Mortgage and Housing Corporation estimates that over 2 million mortgages will renew in 2025 and 2026. That is hundreds of billions of dollars of debt that needs to be repriced. When these homeowners signed their papers in 2021, they were stress tested at 5%, but the actual rate they paid was 1.5. When they walk into the bank in 2026, the new rate will be 5% or 6%. For a standard mortgage of $500,000, the monthly payment will jump from $2,000 to over $3,000. That is a 50% increase. That is money that has to come from somewhere, from the grocery budget, from the retirement savings, from the children's education fund. This is the payment shock that the Bank of Canada has been warning about. It will cause a recession. It will cause consumers to stop spending. It will hurt. But for the prime borrower, the person with a steady job at the bank, it will be painful, but survivable. They will cut back on vacations. They will drive their old car for another 5 years. They will survive. But for the subprime borrower, for the shadow market, 2026 is not a shock. It is an execution. Remember how the shadow market works. These borrowers are not on 5-year terms. They are on 1-year terms. They have been surviving by playing a game of refinance roulette. Every year, they go to a new lender to pay off the old lender. They use the rising equity in their home to pay the fees and the interest. It is a Ponzi scheme of debt, relying entirely on the assumption that house prices will keep going up. But in 2026, prices are flat or falling. The equity is gone, and the interest rates are no longer 10%. They are 15%. Imagine you are a shadow lender. It is renewal time. You look at your borrower. You know his income documents were fake. You know he is struggling. You look at the house. You see that prices in the neighborhood have dropped 10%. Are you going to renew that loan? No. You are going to panic. You are going to demand your capital back. You are going to say, "We are not renewing. Pay us in full, now." The borrower frantically calls other lenders, but they are all saying the same thing. The liquidity has dried up. The yield chasers want their money back. The music has stopped. There is no refinance option. There is no white knight coming to save them. When a shadow borrower cannot renew and cannot pay, there is only one outcome left. It is the ugliest term in Canadian real estate law: power of sale. In the United States, foreclosure is a long judicial process that can take years. In Canada, power of sale is swift and brutal. The lender can evict the homeowner in a matter of months. They take possession of the property, and unlike a homeowner who wants to sell for the highest possible price, the lender does not care about profit. They only care about speed. They want their cash out before the market crashes further. They will dump the house on the market for whatever they can get. This is the trigger event. When one shadow lender forces a sale at a low price, it sets a new comparable for the entire street. Suddenly, every other house on that street is worth less. The loan-to-value ratios of all the other lenders get worse. They panic. They issue their own power of sale notices. It becomes a feedback loop from hell. Forced selling drives down prices. Lower prices trigger more forced selling. And waiting at the bottom of this spiral is the Canadian economy itself. When the power of sale signs start multiplying on lawns across the suburbs, we enter the final phase of the crisis: the death spiral. This is a concept that most Canadians struggle to understand because we have been conditioned to believe in the V-shaped recovery. We think that if prices drop, they will bounce back up 6 months later. We think the government will save us. But the government cannot save a market where the sellers are forced to sell and the buyers are legally unable to buy. Here is how the contagion spreads from the shadow banks to the big banks. Imagine you are a responsible homeowner. You have a mortgage with TD Bank. You have good credit. You think you are safe from this chaos. But your neighbor, the speculator, funded his purchase with a private loan. When the shadow lender forces the sale of his house, they dump it for $800,000. Last year, it was worth $1.2 million. Real estate is valued based on comparables. The moment that gavel strikes, the value of your house instantly drops to $800,000. The equity you thought you had evaporates. Now, multiply this by thousands of distressed sales across the country. Suddenly, the big banks look at their loan books and realize they are sitting on billions of dollars of negative equity. The house is worth less than the mortgage. They stop lending. They tighten credit even further. The economy grinds to a halt. This is the nightmare of a balance sheet recession. We have to be honest about what Canada has become. Over the last 20 years, we stopped investing in innovation. We stopped investing in productivity. We decided that we would build an entire economy on selling houses to each other. Real estate, construction, and finance now make up a massive percentage of our GDP. It is the engine of the Canadian economy. And we just poured sugar in the gas tank. When the housing market crashes, it doesn't just mean your house is worth less, it means the construction sites shut down. It means the real estate agents, the mortgage brokers, the lawyers, the contractors, and the furniture stores lose their income. Unemployment spikes. And when unemployment spikes, even the safe borrowers start defaulting on their mortgages. So, what happens next? We don't have to guess. We just have to look at history. We look at Japan in 1990. We look at the United States in 2008. We enter the lost decade. Prices will not recover in a year. The bubble was too big. The leverage was too extreme. We are facing a long, slow bleed. A decade of stagnation where house prices drift lower, year after year, until they finally reconnect with local incomes. For the baby boomers who were counting on their home equity to fund their retirement, this is a tragedy. The wealth they thought was real was just a paper illusion. For the investors who chased yield in the shadow market, it is a total wipeout. But, and this is the hardest part to say, this crash is necessary. In economics, there is a concept called creative destruction. Sometimes a forest fire is needed to burn away the dead wood so that new trees can grow. For 15 years, the Canadian housing market has been a mechanism of inequality. It transferred wealth from the young to the old, from the worker to the speculator. It told a generation of young Canadians that hard work doesn't matter, only asset ownership matters. The collapse of the shadow banking system is the end of that lie. It will be painful. It will be ugly. There will be bankruptcies. There will be lawsuits. There will be anger. But for the young generation, for the renters, for the families who did the right thing and didn't take on toxic debt, this crash is the only hope. It is the only way to reset the system. It is the only way to make housing a home again, instead of a casino chip. So, what should you do? The shadow banks are not your friends. They are not a lifeline. They are an anchor tied around your neck, and they just threw it overboard. If you are currently holding a private mortgage or an interest-only loan, you are in the danger zone. Please assess your risk immediately. Speak to a licensed professional. The refinance window is closing rapidly. If you are an investor in a private mortgage fund, ask about your redemption rights today. If they tell you that you can't have your money, then you already know the truth. And if you are waiting to buy, wait a little longer. Don't try to catch a falling knife. The storm is not coming. The storm is here. History is a ledger. It records every debt, every excess, and every lie. For 18 years, Canada has been cooking the books, but the audit has finally begun. For the Northern Ledger, thanks for watching.